After huge gains over the past year, China's stock markets are now experiencing the reckoning. The market has tumbled by more than a third in the past few weeks, wiping trillions of dollars off the value of listed companies. Half the shares on China's two stock exchanges have been suspended, while the government is pulling out all the stops to underpin the market. Analysts in Hong Kong say the current rout is simply the unwinding of a bubble.
What we have seen in the past 3 weeks is actually the diffusion of the bubble part of this big rise. When I look at the fundamentals, they haven't changed much.
We think that their efforts actually are not intended to shot up the market and back to its earlier rising trend, but instead their efforts are supposed to stabilize the market.
Well, I think the Chinese equity bull market was a byproduct of all the easing measures that they took last year and early this year to support the property market. So I think in all of this sort of retracement we're having in the equity market, it's good to remember that the main game is still the property market, which in China is the de facto bond market.
China's markets are unusual in that they are dominated by retail rather than institutional investors. That means the wisdom of crowds drives the market, which can lead to rapid changes in sentiment.
Now, the problem is when things come down fast, there is a herd instinct going into the market, especially in the Chinese market, because most of the investors are retail.
There are a lot of unknowns as to how much leverage in the market, how much the banking system has lent to retail investors, to others.
But even though millions of Chinese people trade stocks, active investors are still a relatively small portion of the population.
Of course, not everyone in China is jumping out of a tall building because the stock market is crashing. I'm standing here outside a McDonald's in one of the busiest parts of Shanghai. Inside, there's a store clerk who says she trades stocks, but she's frankly too busy serving customers right now to check what's going on with her stocks. The manager says he doesn't trade stocks. The reason is because of what happened the last time the Shanghai market crashed in 2008. Lots of people got burned, and they were just starting to recover in time for it to happen all over again. So he's not risking it. In fact, most of the people we asked said they don't trade stocks at all. They either don't have the money or they think it's too risky. Given what's going on right now, and they all know what's going on right now, they're plenty glad they never got into this market in the first place.
Even if the average man on the street is unaffected by the stock market, what about the real economy and China's plan to overhaul its financial system?
We don't see much impact on the real economy, but we do worry that in all the sort of actions being taken at the moment, that some of the key financial reforms could get delayed.
A window of opportunity to revisit its way of implementing reforms and handling crisis-like situation. But if Beijing missed this window of opportunities, then what Beijing did in the past week and probably going forward in saving the market will go down history as a bad thing.
China's stock markets remain relatively unconnected to the rest of the world, making direct contagion unlikely.
China's financial integration into the world is still an ongoing process, and foreign investors' exposure to Chinese assets is still quite limited. So whatever happens in China stays in China.
But that doesn't mean it won't have any impact. Other markets around the region have started to feel the effects. Hong Kong's Hang Seng index has dropped by 1/10 over the past week. The Australian dollar is at its weakest since 2009, while iron ore prices are at an all-time low.
This incident may have some impact on global investors' sentiment, how they see this market, how they see the regulators' behavior, and so on.
If this domestic reform process is not managed well, it may trigger a major crisis in China.
With Beijing now doing all it can to bolster the market, but billions of dollars of leveraged bets still to be unwound, the one thing you can bet on is more volatility. Josh Noble, Financial Times, Hong Kong.